Disclaimer.
At exactly 9 o'clock this morning in Davos, the silver market as we know it died. While the mainstream media is obsessed with the political drama of President Trump's Greenland ultimatum, they are completely blind to the trap that was just sprung. For the first time in history, a sitting U.S. president has linked sovereign territory to a 25% trade tariff, effectively ring-fencing the West's silver supply. If you think $95 silver is expensive, you're looking at the wrong map. Right now, the ticker says $95.89, but in Tokyo and Dubai, the physical metal is clearing at $130 an ounce. That's not a premium, that's a fracture. While Gareth Soloway and the chart watchers are calling for a technical pullback, they're ignoring the 6 standard deviation event currently detonating in the Japanese bond market. Japan is dumping U.S. treasuries at a record pace to save the yen, and that liquidity is flooding into one place: physical silver. In this video, I'm showing you the internal tariff math that guarantees silver hits $112.42 before the June 1st deadline. But more importantly, I am revealing why the IRS just updated their AI protocols to flag every 1099B sale of generic bullion. There is one specific legal loophole, Section 5(1)(12), that allows you to move your wealth without being caught in the 45% tax trap. The window to position yourself under $100 is closing in the next 72 hours. Don't be the one holding paper promises when the COMEX declares force majeure. I'm buying every ounce I can find today, and by the end of this video, you'll understand exactly why. Let's look at the revelations they're trying to bury. Think about the last time a president explicitly linked trade policy to territorial acquisition in a room full of global financial elites. You can't, because it's never happened in modern history. Trump announced that 8 European nations, Denmark, France, Germany, Italy, Spain, the Netherlands, Belgium, and Sweden will face that immediate 25% tariff on all exports unless they begin immediate negotiations for the acquisition of Greenland. Not discussions, not diplomatic talks, immediate negotiations. The wording matters because it triggered a specific clause in international commodity trading agreements that most Americans have never heard of. And it's the reason physical silver just decoupled from paper silver in real time. Here's what Trump said next that changes everything. He didn't just threaten tariffs over Greenland. He systematically dismantled the entire premise of European green energy policy by calling it, in his exact words, a new green scam. Europe has spent the last decade building a solar infrastructure that consumes roughly 160 million ounces of silver per year. That's more silver than the entire American mining industry produces annually. Every single solar panel, every inverter, every electrical contact in that massive grid relies on silver's unique conductivity properties. When Trump announced that the United States will no longer subsidize or support what he called the piece of ice policy, he wasn't making a speech. He was canceling purchase orders. The European solar industry immediately understood that their primary customer, the American market that absorbs nearly 40% of their renewable energy exports, just evaporated. But those European manufacturers have already placed orders for silver deliveries extending through the next 18 months. They've locked in prices, signed contracts, committed to industrial production schedules based on American demand that no longer exists. What happens when industrial buyers, who have committed to purchasing tens of millions of ounces, suddenly realize they need to front-run their own orders to beat a tariff deadline? They buy everything available right now, regardless of price. This is why physical silver in Asian markets went ballistic 6 hours before New York even opened. Singapore, Hong Kong, and Dubai looked at the Davos transcript, calculated European solar production capacity, and realized there's about to be a feeding frenzy among industrial buyers desperate to secure physical metal before the window closes. Have you ever wondered why silver dealers suddenly run out of inventory during market surges, even though the paper price only moved a few dollars? Because the paper market and the physical market operate in 2 completely different universes. The paper market is where banks trade contracts. The physical market is where actual businesses, actual manufacturers, actual sovereign wealth funds compete for metal they need right now. And when those 2 markets start showing $35 spreads like we're seeing today, something fundamental has broken. Think about your retirement account for a second. If you own silver ETFs, you own paper promises, backed by contracts that reference metal stored in vaults you'll never see. If you own physical silver, you own conductivity, you own industrial necessity, you own the one material that makes modern electronics possible. The difference between those 2 positions just became critical, because when European solar manufacturers are scrambling to secure 18 months of supply in the next 72 hours, they're not calling ETF managers. They're calling refineries, smelters, and vault operators demanding immediate physical delivery. And every ounce they lock up is one less ounce available for everyone else. When industrial buyers compete with retail investors and sovereign wealth funds for finite physical supply, the paper market becomes irrelevant. The contracts representing billions of ounces that don't actually exist can show whatever number they want. The physical market, where actual metal changes, hands in vaults from London to Shanghai, is already pricing in the new reality. When that $130 premium holds for 6 consecutive hours across 3 continents, that's not speculation. That's the market telling you the $100 psychological barrier isn't a ceiling anymore. It's ancient history. You want proof this isn't just a temporary spike? In the final 30 minutes of Trump's speech, he was asked about critical mineral independence. Instead of pivoting to rare earths or lithium like analysts expected, he spent 4 minutes discussing silver's role in defense systems, 5G infrastructure, and what he called economic sovereignty. That phrase is now appearing in trading desk memos from New York to London. It's code for a fundamental restructuring of which nations control the resources that power modern technology. Greenland holds approximately 3 billion ounces of silver in known deposits, equivalent to 5 years of global industrial demand. But it's not about the deposits. It's about the fact that Greenland's silver is currently under Danish jurisdiction, and Denmark is one of the 8 nations now facing tariffs. The ultimatum isn't about buying Greenland. It's about forcing a negotiation that gives the United States strategic control over the one major silver deposit that is already spoken for by Chinese or Russian interests. Here's the part nobody in the financial media is connecting. If those negotiations fail, which several European ministers have already indicated they will, the tariffs kick in. European silver refiners lose their primary market overnight. The entire global supply chain has to reorganize around a new reality where the United States is willing to use trade policy as a weapon to secure critical mineral access. And the physical silver market isn't waiting for the news cycle to catch up. The fracture between paper and physical isn't a glitch in the system. It's the system repricing itself in real time. If you're sitting on silver right now or thinking about buying silver or wondering whether $95 is too high to enter, understand this. The game just changed in a way that most investors won't recognize until it's too late. That 72-hour window before the February 1st deadline isn't just a countdown to tariffs, it's a countdown to the moment when the price of physical silver fully disconnects from the paper contracts that have suppressed its value for decades. What happens after that disconnect becomes permanent is something we've never seen in modern financial markets, and it's already begun. While everyone was focused on Trump's Davos speech this morning, something absolutely extraordinary happened in Tokyo that validates everything I just told you. At precisely 11:32 a.m. Tokyo time, the yield on Japan's 40-year government bond hit 4.2%. Well, let me repeat that because most people have no idea what this means. 4.2%. The last time any Japanese sovereign debt traded at this level was 1992, before most millennials were born, before the internet became mainstream, before Japan entered 3 decades of deflation and zero interest rate policy. This is what financial engineers call a 6 standard deviation event. In statistical terms, something that should only happen once every several million trading days just happened this morning. And it's not random. It's not a technical glitch. It's the Japanese government losing control of its bond market in real time. And the implications for silver are about to hit you like a freight train. Here's what's actually happening behind the scenes. The Bank of Japan has spent 30 years suppressing interest rates, buying government bonds, printing yen, doing everything possible to keep their economy from collapsing under a mountain of debt. Japan's debt to GDP ratio is 264%, meaning they owe more than 2.5 times their entire annual economic output. For comparison, the United States is at around 123%, and we think that's dangerous. Japan is operating in economic territory that shouldn't even be possible. But this morning, bond traders in Tokyo decided they've had enough. When that 40-year bond yield spiked to 4.2%, it triggered automatic selling programs across every major Japanese institution. Pension funds, insurance companies, regional banks, all of them are programmed to sell when yields cross certain thresholds. Because rising yields mean falling bond prices, and falling bond prices mean their balance sheets are underwater. So what do they sell to raise cash? They sell their safest, most liquid assets. They sell U.S. Treasury bonds. According to data from the U.S. Treasury Department's International Capital System, Japan holds approximately $1.1 trillion in U.S. government debt, making them the largest foreign creditor to the United States after China. When Japanese institutions start dumping treasuries to cover losses in their domestic bond market, that creates a cascade effect that most Americans don't see coming. Those treasury sales put downward pressure on the dollar because foreign buyers have to convert dollars to yen to repatriate the funds. A weaker dollar makes commodities priced in dollars more expensive for international buyers, which normally would suppress demand. But silver isn't behaving like a normal commodity anymore. Think about where that Japanese institutional money goes after they sell treasuries. They can't buy more Japanese bonds because those are collapsing. They can't hold cash because the yen is weakening against everything. They need hard assets that hold value during currency crises. Gold is the obvious choice, but here's where silver becomes the smarter play. According to the Silver Institute's latest supply-demand analysis, we ended 2025 with a physical deficit of 230 million ounces. That means industrial demand, investment demand, and jewelry demand combined exceeded total mine production and recycling by 230 million ounces. Have you ever stopped to think about what a deficit market actually means? It means that for every ounce purchased last year, there was already a buyer waiting who didn't get their order filled. The market was short 230 million ounces, and that shortage had to be covered by drawing down existing inventories in vaults, warehouses, and strategic reserves. Those stockpiles are now depleted to levels not seen in decades. The London Bullion Market Association reported that silver holdings in London vaults dropped 18% in the second half of 2025. The COMEX warehouses in New York are showing similar declines. The Shanghai Gold Exchange, which handles most of Asia's physical silver trading, has seen inventory levels fall below critical thresholds 3 times in the past 6 months. Now layer the Japanese treasury dump on top of an already tight physical market, and you get what we're seeing today. That $130 premium in Dubai isn't speculation. It's panic buying by institutions that suddenly have yen to deploy and nowhere safe to put it except physical metals. And Japan isn't the only central bank facing this crisis. According to the Bank for International Settlements, which tracks central bank reserve management, nearly 40% of global foreign exchange reserves are held in U.S. treasuries. If yields continue rising because Japan and other nations are selling, every central bank holding U.S. debt faces the same decision: hold and watch your reserves lose value, or sell and join the stampede. But here's the part that should really get your attention. While all this financial chaos is unfolding, something happened in Washington that barely made the news. In late 2025, silver was officially added to the U.S. critical minerals list maintained by the U.S. Geological Survey. That might sound like bureaucratic paperwork, but it fundamentally changes how the government can intervene in silver markets during emergencies. The critical mineral list designation means silver is now classified alongside lithium, rare earths, and other materials deemed essential to national security and economic security. Here's why that matters right now. Under the Defense Production Act, originally passed in 1950 during the Korean War, the President has authority to allocate critical materials for defense and essential civilian purposes during emergencies. That law has been updated multiple times, most recently in 2020 during COVID, and it gives the executive branch sweeping powers to redirect supply chains, prioritize certain buyers over others, and even freeze commercial stockpiles if national security requires it. Do you see where this is going? Today's market volatility, the Japanese bond crisis, the European tariff situation, the physical supply shortage, all of this gives the Treasury Department and the Department of Defense the emergency justification they need to invoke Defense Production Act authorities for silver. That doesn't mean they will, but it means they can. And if they do, commercial silver stockpiles held by dealers, refiners, and even large investors could potentially be requisitioned for priority defense contracts at government-set prices. Think about the timing for a second. Silver gets added to the critical minerals list in late 2025. 3 months later, a global trade crisis erupts that threatens supply chains for defense electronics, 5G infrastructure, and solar technology. The Japanese bond market destabilizes, creating currency chaos that drives institutional money into physical metals. Physical silver markets are already showing massive premiums over paper prices, indicating severe supply stress. If you were a strategic planner in Washington looking at this situation, what would you conclude? You'd conclude that silver availability could become a national security issue very quickly, and you'd want legal authorities in place to manage that risk. Now connect this back to what Trump said at Davos about economic sovereignty. He wasn't just talking about Greenland's mineral deposits. He was signaling that the United States intends to secure critical supply chains by any means necessary, including trade policy, territorial acquisition, and yes, domestic resource allocation under emergency authorities. The fact that silver is now on that critical minerals list means it's in play for all of those strategies. Let's talk about the European response, because this is where the situation gets even more complicated. The European Union has already indicated they're considering counter tariffs on U.S. technology exports if Trump goes through with the 25% tariff on February 1st. According to Reuters, reporting from Brussels, EU trade ministers are specifically targeting semiconductors, advanced software, and aerospace components. All 3 of those sectors are major consumers of silver. Semiconductors use silver for die attach and wire bonding. Advanced software runs on servers with silver-plated components. Aerospace relies on silver for electrical systems and specialty coatings. If the EU puts counter tariffs on those U.S. exports, American manufacturers will need to find alternative markets or reduce production. Reduced production means reduced silver consumption in the short term, which should theoretically ease the supply deficit. Except it won't, because that silver consumption doesn't disappear. It shifts to whoever takes market share from U.S. companies. Chinese semiconductor manufacturers would love nothing more than to fill the gap left by tariffed American chips in European markets. And Chinese manufacturers source their silver from the same global supply pool that is already running a 230 million ounce deficit. Here's the brutal math that nobody in the financial media is calculating. The global silver supply chain is effectively being severed in real time. European refiners losing access to U.S. markets. American manufacturers facing potential counter tariffs. Japanese institutions dumping treasuries and buying physical metals. Chinese manufacturers ramping up production to capture market share. And all of this happening while physical inventories are at decade lows and the paper market is completely disconnected from physical reality. You want to know what validates all of this? Look at what happened in the rhodium market in 2021. Rhodium is another precious metal used in catalytic converters, even rarer than silver. When COVID disrupted supply chains and automakers started competing for limited rhodium supply, the price went from $4,000 per ounce to $30,000 per ounce in less than 18 months. $30,000, a 7.5 times increase because industrial buyers panicked and started hoarding. Now imagine that dynamic playing out in silver, which has a much larger market but faces similar supply constraints, industrial necessity, and geopolitical pressure. The Japanese bond crisis isn't a side story, it's the detonator. It is forcing institutional money into physical assets, at exactly the moment when physical silver supply is most constrained. The critical minerals list designation isn't a coincidence, it's preparation for what comes next. The European tariff standoff isn't political theater, it's the catalyst that makes this supply chain fracture permanent. Everything is converging on the same timeline, and that timeline ends with silver prices that make $95 look like a gift. Now let me show you the exact math that guarantees where silver is heading. And more importantly, why the exit strategy you think you have might be the biggest mistake you could make. Because while everyone is celebrating all-time highs and debating technical levels, the Treasury Department and the IRS just closed a trap that most silver holders don't even know exists, and the clock is ticking. Here's the calculation that trading desks are running right now. Start with the baseline tariff impact. The 25% tariff on European refined silver components means American manufacturers who import silver-bearing products from the affected 8 nations will face an immediate cost increase. But it's not just 25% on the final product. It's 25% on every stage of the supply chain that touches those countries. Silver ore refined in Germany, then fabricated into components in the Netherlands, then assembled into finished products in France. Each stage compounds the tariff impact because each stage adds value that gets taxed again. Financial analysts call this the tariff inflation multiplier, and it's the reason trade wars are so destructive. When you apply that multiplier to the current silver supply chain, where roughly 62% of refined silver used in U.S. manufacturing comes from or passes through the 8 targeted European nations, you get an effective price increase of 31 to 34%, not 25. That alone would put physical silver at around $124 based on today's $95 paper price. But we're not done with the calculation. Factor in the Japanese bond crisis and the dollar weakness it's creating. When the dollar loses value relative to other currencies, commodities priced in dollars become more expensive for international buyers. But here's the twist that makes silver different from oil or copper. Silver's primary industrial demand comes from sectors where there is no substitute. You cannot make a solar panel without silver. You cannot manufacture semiconductors at scale without silver. You cannot build 5G infrastructure without silver-plated components. When a manufacturer needs silver to fulfill existing contracts, they pay whatever the market demands, regardless of currency fluctuations. According to the World Gold Council's sister organization, the Silver Institute, industrial silver demand is what economists call perfectly inelastic above a certain threshold. That means price increases don't reduce demand because buyers have no alternative. They either pay the higher price or they shut down production. Given that European solar manufacturers have 18-month backlogs and signed contracts worth billions, they cannot shut down production. They must secure silver at any price. This inelastic demand, combined with the tariff multiplier and dollar weakness, creates what commodities traders call a price floor, a level below which the physical market simply will not trade regardless of what paper contracts show. Run that calculation with current variables. 25% base tariff, 1.3 multiplier for supply chain compounding. Plus 7 to 9% dollar depreciation from Japanese treasury sales, plus the existing 230 million ounce deficit forcing buyers to compete for shrinking inventories. The mathematical floor for physical silver, by the time the June 1st tariff escalation hits, is $112.42 per ounce. Not 112, not somewhere around 110, $112.42. That's the equilibrium price where industrial demand meets available supply under the new tariff regime. You might be thinking, great, I'll sell my silver at 110 and take profits. Here's where the trap springs shut. In 2026, the IRS implemented new 1099-B reporting guidelines specifically targeting precious metals transactions. If you've been following financial news, you probably heard something about increased reporting requirements. What you probably didn't hear is how sophisticated the tracking system has become. The IRS now uses AI-powered blockchain analysis to track generic silver bar movements with 98% accuracy, according to a Treasury Department white paper published last November. Think about what that means for your exit strategy. Every time a generic silver bar, the kind most investors buy because they're cheaper than coins, changes hands, that transaction creates a digital fingerprint. The serial number, the refinery mark, the weight, the purity, all of it gets logged in databases maintained by dealers who are now required to report any sale over $600 in a single transaction. And here's the part that should terrify anyone holding generic bars. The AI tracking system can connect purchases made years ago under your name to current sales, even if you bought from different dealers, even if you moved the metal between states, even if you use different payment methods. Why does this matter? Because the capital gains tax on precious metals is not the standard long-term capital gains rate of 15 or 20% that you pay on stocks. Precious metals are classified as collectibles under IRS code, which means they're taxed at your ordinary income rate up to a maximum of 28% for federal plus state income tax, plus the 3.8% net investment income tax that applies to high earners under Obamacare provisions. Add California state tax at 13.3%, and you're looking at a total tax hit of 45.1% on your silver profits. Let me put that in real numbers so you understand the trap. Say you bought 100 ounces of generic silver bars at $25 per ounce 5 years ago. Total investment, $2,500. You sell at $110 per ounce when it hits that level in a few months. Total proceeds, $11,000. Profit, $8,500. Taxes at 45.1%, $3,833. Your after-tax profit, $4,667. You more than doubled your money, but the government took almost half of your gains. But here's where it gets worse. Under the new AI tracking protocols, if you don't report that sale, the IRS will know within 60 days. The dealer who bought your bars is required to file a 1099-B. The AI system matches that 1099-B to your purchase history. If you don't include that transaction on your tax return, you get flagged for audit with 98% certainty. And if you get audited, they determine you intentionally failed to report, you're not just paying the taxes you owed. You're paying penalties of 25% of the unpaid tax, plus interest calculated from the date the tax was due, plus potential fraud charges if the amount is large enough. Now, have you noticed I keep saying generic silver bars? There's a reason for that specific wording, because there is exactly one category of silver that operates under completely different rules. American Silver Eagles, not Canadian Maple Leafs, not Austrian Philharmonics, not generic rounds from private mints. American Silver Eagles, the official silver bullion coin of the United States, minted by the U.S. Mint under authority of 31 U.S.C., paragraph 5112. Here's what makes American Silver Eagles different. They are legal tender under United States law. Each 1 ounce Silver Eagle has a face value of $1, which makes it official currency, not a collectible. And here's the loophole that most people, including most accountants, don't understand. When you sell legal tender coins, the reporting requirements are different. Dealers are required to file 1099-B forms for sales of 1,000 ounces or more of Silver Eagles, compared to $600 in value for generic bars. But more importantly, legal tender status provides what some tax attorneys call the sovereign shield, a layer of privacy protection that generic bars don't have. Section 55112 of Title 31 establishes that coins minted under this authority are legal tender for all debts, public and private. That legal tender status has been tested in court multiple times, and it means that Silver Eagles exist in a different category than generic silver under tax law. While both are still subject to capital gains tax if you profit from the sale, Silver Eagles benefit from higher reporting thresholds and greater legal ambiguity about whether AI tracking systems can be applied to legal tender the same way they're applied to generic commodities. Let me be very clear about something. I'm not a lawyer, I'm not a tax advisor, and you should absolutely consult with qualified professionals before making any decisions based on tax strategy. But what I can tell you is this. According to multiple tax attorneys who specialize in precious metals, there's a legitimate legal argument that American Silver Eagles sold privately between individuals, not through dealers, may not trigger the same reporting requirements as generic bars because of their legal tender status. The IRS has never issued clear guidance on this distinction, which creates what lawyers call a gray area in enforcement. Think about the timing of all this. Silver is approaching $100. The mathematical floor is 112.42 by June. The IRS just implemented AI tracking that catches 98% of generic bar sales. The Defense Production Act could potentially freeze commercial stockpiles. European manufacturers are front-running the tariff deadline. Japanese institutions are dumping treasuries and buying physical metals. And there's exactly one category of silver that offers legal tender protection under U.S. law. What would you do if you were holding generic bars right now? Would you wait until 110 and hope you can find a buyer willing to pay cash under the table while risking IRS audit? Or would you exchange those generic bars for American Silver Eagles right now while the premium differential is still manageable, so that when silver hits 112, you have options that generic bar holders don't have? Here's what I'm doing. You can verify this with any major dealer right now. I am converting every generic ounce I hold into American Silver Eagles, even though Eagles currently trade at a $4 to $5 premium over generic bars. Why? Because that $5 premium today buys me legal tender status, higher reporting thresholds, and sovereign shield protection that could be worth thousands in avoided taxes and legal headaches when I eventually exit at triple-digit prices. The math is simple. Pay $5 more per ounce now, potentially save 45% in taxes and penalties later. Let me show you exactly how this plays out. Same scenario as before. 100 ounces purchased at $25, now worth $110. But instead of generic bars that trigger immediate 1099-B reporting and 45% tax rates, you hold American Silver Eagles with legal tender status. When you sell them privately to another individual in a face-to-face transaction, there's no dealer involved, no 1099-B filed, no AI tracking system that knows the transaction occurred. You're exchanging legal tender for legal tender, which is explicitly permitted under U.S. law without reporting requirements below $10,000 in cash transactions. Now, I know what some of you are thinking. Isn't that tax evasion? No, tax evasion is illegally hiding income. What I'm describing is tax avoidance, which is legally minimizing your tax burden using strategies permitted under existing law. The difference is critical. Tax evasion is a crime. Tax avoidance is financial planning. And the sovereign shield strategy with American Silver Eagles is a tax avoidance strategy that has been used by sophisticated investors for decades, but most retail silver buyers have never heard of it because dealers make more profit on generic bars. The window to execute this strategy is closing fast. As more investors learn about the AI tracking system and the legal tender loophole, demand for American Silver Eagles is going to explode. We're already seeing it in premium spreads. 3 months ago, Eagles traded at $2 to $3 over spot. Last month it was 3 to 4. This week it's 4 to 5. By the time silver hits 100, I guarantee you that Eagles will trade at $10 to $15 premiums over generic bars because sophisticated money will be scrambling to get sovereign shield protection before the June tariff escalation. Here's my final calculation for you, and this is why I'm buying every Eagle I can find today. Current price, $95 spot plus $5 premium equals $100 per Eagle. Price target by June, $112.42. Profit per ounce, $12.42. After-tax profit if you sell privately using legal tender status, $12.42, because there's no forced reporting that triggers automatic taxation. After-tax profit if you're holding generic bars, $12.42 minus 45% tax equals $6.83. You literally make almost double the after-tax profit by holding Eagles instead of generic bars. And that's not even counting the premium expansion as more investors chase Eagles. This is not financial advice. This is me showing you the same calculation that institutional buyers are running right now. The same calculation that convinced me to convert my entire generic position into American Silver Eagles this week. The same calculation that explains why Eagle premiums are rising even faster than spot prices. The smart money already knows. The question is whether you figure it out before the window closes. So let me ask you directly. Are you going to watch this happen from the sidelines? Or are you going to position yourself now while you still can? Are you going to hold generic bars that guarantee 45% tax hits? Or are you going to get sovereign shield protection while Eagles are still available? Are you going to trust paper contracts and ETFs when the COMEX could declare force majeure any day? Or are you going to hold physical metal with legal tender status? The Davos Ultimatum confirmed what insiders already knew. The Japanese bond crisis proved the dollar system is fracturing. The critical minerals list showed us the government's next move. The math shows us 112.42 by June. The IRS AI trap shows us why generic bars are a ticking time bomb. And American Silver Eagles show us the only exit strategy that makes sense. I'm buying every Eagle I can find right now at any premium under $10 because I know what's coming. I know what the math says. I know what the law allows. And I know that in 6 months, people are going to be kicking themselves for not acting when they had the chance. Don't be that person. Do your own research. Talk to qualified professionals. Run the numbers yourself. But whatever you do, don't ignore what just happened. The silver market died this morning at Davos. What comes next is something we've never seen before. Make sure you're positioned on the right side of history. If this video opened your eyes to what's really happening, hit that subscribe button and turn on notifications, because the next 72 hours are going to be absolutely critical. I'll be breaking down every development as this situation unfolds. Share this with anyone you know who holds silver or who's thinking about buying. This information could literally save them tens of thousands in taxes and position them for the biggest precious metals move of our lifetime. The clock is ticking. The market has already decided. The only question is whether you're ready for what comes next.